Good afternoon. I'm going to go ahead and get started with the presentation on property tax assistance. And this is a summary of the Property Tax Tuesday schedule we have done. We're on the property tax assistance one, and these are recorded and available on the legislative website. We have one more coming up on October 29th on property taxes and school funding. So for the property tax assistance presentation today, I'm going to take you through the property tax assistance programs for residential property taxpayers. My contact information is included here on the first slide, and there are some links throughout this presentation, and the slides will also be made available online as well. So this presentation is largely based on a property tax assistance program overview that I've written, and that's linked at the top of the page here. In Montana, we have 4 property tax assistance programs for residential taxpayers, and they can be broken into 2 general categories. The first category is property tax assistance that is in the form of a property exemption, and this means that a portion of the value of the property is exempt from taxation, so less taxes are paid on that property. The other form is an income tax credit, in which an income tax credit is available for property taxes paid. We have 3 programs that are in the form of property exemptions. Those are the Property Tax Assistance Program, also often referred to as PTAP, the Disabled Veteran Program, also referred to as DAV, and the Intangible Land Value Exemption. We have 1 income tax credit. It's the Elderly Homeowner and Renter Credit, and that's sometimes referred to as 2EC. 2 is just a reference to the income tax form 2, and EC references the elderly credit. We're going to go through each of these programs in detail and then look at some examples and some data. The first is the Property Tax Assistance Program. This is a program that reduces the taxable value on up to $350,000 of market value to 20%, 50%, or 70% of the value based on the income of the owner. For 2024, the maximum income amounts to be eligible for the program were $27,621 for a single person and $37,019 for a married or head of household taxpayer. I will note that the income amounts are updated annually for inflation, and the $350,000 market value figure is updated every 2 years for inflation, and that's because the reappraisal cycle for residential property is 2 years. This program also requires the owner to own and occupy the property for at least 7 months of the year, and if a person moves during the tax year but their residency in 1 or more properties combines to 7 months, they are still eligible for the program. There is an initial application for the program, and then once a person is enrolled, they must annually verify their income to the Department of Revenue. There are a couple of changes that the 2023 legislature made in House Bill 189, and I wanted to highlight those here. The first is the value that is eligible for the program increased from $200,000 to $350,000, and the income thresholds are also expanded so that a person receives higher levels of assistance at higher levels of income. The next program is the Disabled Veteran Program. This program reduces the taxable value of a property for a 100% disabled veteran or the surviving spouse of a 100% disabled veteran to 0%, 20%, 30%, or 50% of the value, again, based on income. I'll note here that this program does not have a market value limit, so the entire value of the residential property is eligible for the program. In 2024, the maximum income amounts are $59,554 for a single taxpayer, $68,705 for a taxpayer who is married or the head of a household, and $51,911 for an unmarried surviving spouse of a disabled veteran. This program also requires ownership and occupancy for 7 months of the year and also requires annual income verification. The third and final property exemption-based program is the intangible land value exemption. Unlike the other two programs, this program is an exemption for the land rather than a residential structure and the land. This program is available for up to 5 acres of land that is valued disproportionately higher than the primary residence located on the land. The way this works is that the land value that exceeds 150% of the primary residence value is exempt from taxation. However, this is subject to the statewide average value of land. So if 150% is less than the statewide average value of land, the statewide average value of land would be used. This program does require ownership by the applicant or a family member for 30 years and occupancy by the applicant for 7 months of the year. And for the purposes of this program, family is what is referred to as the third degree of consanguinity, which includes the parent, child, sibling, grandparent, grandchild, great-grandparent, great-grandchild, aunt, uncle, niece, or nephew. Now moving on to the elderly homeowner renter credit, this is the income tax credit program, and it's a refundable income tax credit of up to $1,150 for homeowners and renters that are 62 years old or older. This is a credit for property taxes paid or 15% of rent paid, again, based on income. This program has a maximum income amount of $45,000, but the credit begins to phase out at $35,000 of income. And in order to participate in this program, a person must reside in Montana for 9 months of the year. I'll also note here that a person who resides in a nursing home, a private nursing home that is not subject to property taxes, is not eligible for the program. However, a county nursing home that is property exempt, a person who resides in that will be eligible for the program. I do also want to note that a person can claim both the elderly homeowner renter credit as well as the property exemption programs. However, the property exemption programs will reduce the amount of property taxes paid, so then their credit under this homeowner renter credit will be smaller. I do want to explain the elderly homeowner renter credit in a bit more detail because the calculation is more involved than the other calculations, and this graphic shows how that calculation works. The first step is to determine the gross household income, which is the federal adjusted gross income without regard to loss plus any non-taxable income. And we're going to talk about income used for the different programs in more detail on the next slide. And this gross household income is determined for all members of the household. That gross household income is then converted to household income by subtracting $12,600 from gross household income. That amount is listed in statute and it is not adjusted for inflation. Next, there is a reduction from this household income amount, and it's a multiplication of the household income amount by a percentage that's listed in statute. And if the gross household income is below $14,600, there is no reduction. And for the amount over $24,600, the reduction is 5%. And then in between those two numbers, the amount stair steps up. After this reduction amount is determined, we subtract the reduction amount from the actual amount of property taxes billed or rent equivalent tax paid, and that gives us the preliminary credit amount. However, if the income is greater than $35,000, then the person only receives a portion of the credit ranging from 10% to 40% of the credit. And finally, we arrive at the credit amount, which is the lesser of $1,150 or the amount determined above. And again, this amount is refundable. So if a person doesn't owe any income taxes, they can still file a return and receive this credit. A note here on income used to determine credit amounts. As you can see in the orange, the Property Tax Assistance Program and the Disabled Veteran Program both use federal adjusted income excluding losses, while the Elderly Homeowner Renter Credit in the blue uses federal adjusted gross income excluding losses and adds back non-taxable income. Non-taxable income may include things like Social Security income that is not paid directly to a nursing home. It can include pensions and annuities, veterans benefits, and alimony. So for this population especially, there may be some non-taxable income that's added back. And we're going to run through an example here in a few minutes that shows how those income amounts can vary for the two programs. In fact, that is our next slide. So this is an example of a taxpayer that's eligible for both the Property Tax Assistance Program and the Elderly Homeowner Credit. So for the purposes of this example, we're assuming the taxpayer is 70 years old with $21,000 in income that's entirely from Social Security, a market value of $350,000, and a mill levy of 650 mills. We'll do the Property Tax Assistance Program calculation first. That's on the left, and the calculations are in the far left column, and the gray column in the middle has some notes. So first, for the purposes of this program, the person's qualifying income is $0. That's because the Social Security income at this level is non-taxable and it's not included in federal adjusted gross income. So at the qualifying income level of 0, this person would receive the highest benefit, which means only 20% of their property value would be subject to taxation and 80% of the value is exempt. To determine the taxable value, we take the $350,000 market value of the property, multiply it by the residential tax rate, which is 1.35%, and then multiply it by the 20% of value subject to taxation. That gives us a taxable value of $945. Now, to determine the taxes due, we multiply the 945 by 650 mills divided by 1,000 to give us a tax bill of $614. That is a savings of $2,457 for the person enrolled in the Property Tax Assistance Program. Now we'll go to the right side. This person is also eligible for the Elderly Homeowner and Renter Credit and can file for that credit using the income tax forms. For this program, we're using gross household income, and for this credit, the gross household income is $21,000. That's because we use the federal adjusted income, but we're adding in the non-taxable income, and that Social Security income is non-taxable, so it gets added back. The household income here again is the gross household income minus $12,600 for a household income of $8,400. We then have to calculate the reduction amount, which comes from statute. The reduction amount here is 3.9%. Multiply that times $8,400, and it gives us a reduction of $328. And that $328 reduction amount is subtracted from the $614 in taxes paid that we calculated on the other side of this graph for the PTAP program. So that gives us a credit amount of $286. So the total property taxes paid less the Elderly Homeowner and Renter Credit for this taxpayer is in green at the bottom. That's $328. And the total benefit from the PTAP and the Elderly Homeowner and Renter Credit benefit is $2,743, which is the total tax bill without assistance would have been $3,071. Now we're going to discuss the fiscal impacts of assistance programs because it varies by type of assistance program. And then we're going to look at some data. So for property exemptions, because these programs reduce the taxable value of the property, they result in tax shifts. And that's because the school funding formula and the maximum mill levy calculation allow local governments and schools to raise a certain amount of money. By exempting a portion of the property value of certain properties, that results in a smaller taxable value and a larger mill levy to raise the same amount of money. The other effect of these property exemption programs is a reduction in state revenue from the state mills, which are the 95 mills for school equalization, the 6 mills for the university system, and in some counties, the 1.5 mills for vocational technical education. Because those mills are set in statute, they don't get to float any mills for those, and that means that they collect less revenue at the state when the taxable value is decreased. On the income tax credit side, there's also a reduction in state revenue because less income tax is collected and some is refunded to taxpayers. There is no property tax shifting here because the person still pays their tax bill and then receives the credit after paying the tax bill. Here's some general property assistance data. For the property exemption programs, the data is for 2023, and for the elderly homeowner renter credit, the data is for 2022. This data is sorted on the second column, the participant column, so you can see that the PTAP program has the most participants, 20,500 in 2023, and the loss in state revenue from those participants in the program is about $3.3 million. The tax shifting that happens in the jurisdictions throughout the state is about $14.9 million for a total benefit to participants of a little more than $18 million and an average benefit of $886. The elderly homeowner renter credit is the second largest program with 16,273 participants in 2022. This is a loss in state revenue of about $10.6 million, and recall that there's no tax shifting here, so that is the total benefit to participants, and the average benefit is $651. The disabled veteran program, as you can imagine, is quite a bit smaller because it requires the participants to be 100% disabled veterans, and there are about 3,243 participants. The loss in state revenue here is a little bit less than $1 million, and the tax shifting is about $6.1 million for a total benefit to participants of $7.5 million. The average benefit here is quite a bit higher than for the other programs. It's $2,337, and there are a few reasons for that. The first is that the entire taxable value of the residence is eligible for the property assistance, and also the income limits for this program are quite a bit higher than they are for the PTAP program. Finally, the intangible land value exemption program is the smallest, with just under 200 participants in 2023 for a loss in state revenue of a little bit less than $150,000 and a tax shift of about $450,000 for a total benefit to participants of $600,000 and an average benefit of $3,028. A couple of other items to mention here. You're probably aware that there were property tax rebates authorized by the 2023 legislature in House Bill 222 and House Bill 816. Those rebates were available in 2023 and 2024, and each of those was for taxes paid in the prior year. Those required a taxpayer to own and occupy their residence for 7 months of the tax year and to have assessed and paid taxes on a residence. And the rebate was equal to $675. It was the lower of $675 or the total taxes paid. We don't have the 2024 rebate data quite yet. I believe the rebate period closed on October 1st, but for 2023, there were 216,419 rebates issued, totaling about $143 million. And the Department of Revenue did put together a rebate report presented to the Revenue Interim Committee that has some more data and also information about the administration of the rebates. If you're interested, that's linked in this slide. Finally, this last slide is not exactly about property tax assistance, but it often is of interest to anyone considering offering legislation related to property tax, especially residential property. And this is the taxable value neutral report. It's required by law for the Department of Revenue to report to the Revenue Interim Committee on the tax rates that will result in taxable value neutrality. There's a screenshot here from the November 2020 report, and you probably heard about that 0.94 rate mentioned as a possible rate for residential property. I do want to point out that this report is not a recommendation, but from the Department of Revenue, it's just required. And this report will be presented to the Revenue Interim Committee on November 18th at their revenue estimate meeting. Oops, wrong way. And that concludes my presentation, and I'm happy to take any questions.